If you own a home with a VA loan, you've probably been bombarded with ads and calls telling you to refinance your house. But should you? My name is Levi Wolf, and I'm an active duty Marine and a licensed realtor, and I also own a couple of properties I bought with a VA loan. And I get spammed with texts and calls and physical mail practically begging me to do a refinance. And after having my friends ask so many questions and make so many mistakes, I can't bear seeing it anymore. So today we're going to go over what a refinance is, why you get an atrocious amount of spam, when the refinance actually makes sense, and how to run the numbers yourself so you don't spend thousands of dollars on a painful mistake. So let's start off with what a refinance is. All the refinance is when a bank gives you enough money to pay off your existing mortgage, which is your existing loan on your house, and you're replacing your current mortgage with a new one. And the new loan usually has different terms, like usually a lower interest rate, it could be a different loan duration, and maybe even a different loan amount. Now, the VA also has a specific refi program for VA loan properties specifically, and we'll dive into that in just a sec. But just understand that the result of a refinance is often to get a reduced monthly payment, but that comes at a cost. And speaking of cost, that's actually the whole reason you get spammed to begin with. See, refinancing is a money-making event for lenders, and it usually comes from three places. First is the loan origination fee. That's what they charge you for processing and underwriting the loan. Second, your loan officer is typically earning commissions somewhere between 0.5% and 2% of the loan amount. So for example, on a $400,000 loan, that could be $8,000 in their pocket. And third, there's points, which is when you pay upfront to buy your interest rate down. Generally, for points, you pay 1% of the loan amount to get you a 0.25% interest rate reduction. So again, for example, on that $400,000 loan, you'd pay $4,000 to drop your interest rate from 6.25% to 6% flat. Think of it like prepaying that interest to the bank. So the combination of origination fees, commissions, and points mean that lenders are highly motivated to get you to do a refinance. And the easiest person to sell to is someone who's already a customer. And because a lot of your information is already public, RIP to your inbox. Now, I'm not saying any of this is wrong, by the way. Making money is not a bad thing, but now you know why your phone won't stop ringing. And so now, when does a refinance actually make sense for you, and what are things that you should be aware of? Here's what you need to know. The core question that you want to know is, does this refinance actually save you money? And the answer to that lives in just two numbers: how much you save per month and how long it takes to earn back what you spent on the refi. That's called your payback period. For example, if it costs you $6,000 in fees to do the refinance and it saves you $200 a month, you divide the two and see that you break even at 30 months. Breaking even means that the monthly savings have fully covered what you spent to do the refi, because after that point, every month is actual savings. But if you sell or move out before then you lost money. The refinance is only worth it if you plan on owning the property longer than your payback period. That's the foundation, but here are three traps that still mess people up even when the math looks good. And the first is a high payback period. I've seen them as high as 8 years. And even if you do plan on holding for forever, that creates a problem where you can't rationally do another refi if better rates come around until you've recouped from the first one. So a long payback period kills your future flexibility too. For active duty especially, if a PCS is anywhere on the horizon, a long payback period is almost always a losing move. 2 to 3 years is what you want to aim for. Now the second trap is when someone tells you that the refi won't cost you anything. Like we covered earlier, there are absolutely costs. But what's happening is that those costs are getting rolled over into your new loan balance instead of coming out directly out of your pocket. You're still paying 100% of the cost, just now you're paying interest on it for however long the new loan is for, which could be 30 years from today, even if you were already 5 years into your original mortgage. And the third one is actually the craziest, and I call it the Great Reset. To understand it, you need to know how amortization works. See, all mortgages are amortized, meaning the start of the loan, the majority of your payment goes to interest, and only a small portion away actually chips away at what you owe. For example, on a $250,000 house at a 6% interest rate, your monthly payment is around $1,500. But in that first year, roughly $1,250 of it is interest, and only $250 of it is paying down your loan. That's over 80% of the payment going straight to the bank. Now, over time, that ratio gradually shifts in your favor, but it takes a couple years. And when you refinance, that entire schedule resets to day one. So if you are 5 years into your loan, now you're starting over. And one bonus thing to watch out for, you might hear that when you refinance, you get a month or two of free mortgage payments. And here's what's actually happening. So when your new loan closes, it pays off your old one so that payment stops. And because mortgages are paid in arrears, meaning that, for example, your February payment is actually paying off January's interest. So whenever you get your new loan, that first payment won't be due for another 30 to 60 days once you get it. So on the surface, it looks like you skipped a month or two, but in reality, the interest during that time, even though you're not paying it, it never stops accruing. So those 2 months of interest just get rolled over and you're still going to see the bill for that. So it's not a free month, it's just a hidden one with no principal payment. Real quick, if you're a military buyer approaching your first or next home purchase and you want to make sure that your next property sets you up for long-term wealth, that's exactly who I work with, because most military buyers lose tens of thousands of dollars because nobody walks them through how to analyze a deal, how to negotiate, or how to use their VA benefit strategically. So that's exactly what I do. And right now, I'm offering an 8-week one-on-one program where we cover everything from financing fundamentals to negotiations and deal analysis, all the way to closing, so you walk away with the home you got the best deal on, and with a repeatable process you can use to build real wealth in real estate. And like I said, it's all done with you every step of the way. So if that sounds like something you might benefit from, check out the description to get on my calendar. Now back to it. So now let's talk about the refinance program that the VA offers, which is the VA Interest Rate Reduction Refinance Loan, also known as the VA IRRRL. And it's the VA's own version of a refi built specifically for veterans in active duty who already have a VA loan. And the reason it's worth knowing is that it's significantly more streamlined than a conventional refinance, and it doesn't require an appraisal, income verification, or a new credit check. It's designed to be fast and low friction, but it does have to hit specific criteria to even be allowed. The VA requires that your interest rate drops by at least 0.5% and that your payback period is no longer than 3 years. It has those built-in protections, but it still has fees that we already discussed, like origination fees, potential points, plus a 0.5% VA funding fee, which if you have a service-connected disability rating, then that fee gets waived. Now, when does the VA IRRRL make sense? So the VA's minimum is that 0.5% rate drop and a 3-year payback period, but personally, I'd want to see at least a 1% rate reduction, and then you have to make sure that the payback period is actually 2 to 3 years, because like you'll see soon, sometimes it's a little over 3 years and that can be a problem. Because remember, the program gives you that protection, but the numbers still have to work in your favor. So let's go over again how to calculate your payback period so you know if you should run the refi or not, and you can run your own numbers after this in 2 minutes. First, take a look at your closing disclosure. It'll tell you what your new interest rate would be and your new monthly payment. Now subtract your new monthly payment from your current one, and remember, we're only comparing the mortgage and mortgage interest, not the taxes or homeowner's insurance. If you don't know what that is, then you can use their estimated one. So here, let's say the original amount was $1,700 a month. On this disclosure, the new payment is $1,500 a month. So subtract the two and your monthly savings is $200. Now let's look at what the total closing costs are here, which is $8,000. Then we just divide the total cost by how much we save every month, and we get 40 months as our break-even point, which is 3 years and 4 months. So if you're using the VA IRRRL, this one wouldn't even qualify. But if you're looking at just a regular refi though, then the only thing you have to do here is ask yourself, am I gonna own this property for another 4 years to make it worth it? And if so, then send it. And with that being said, you now know how to run all the numbers yourself and figure out if that refi is actually worth it before you spend thousands finding out the hard way. And if you learned something, subscribe for more.